My inclination is that the economy's slowing, inflation's coming down, and the Fed has done a good part of its work, if maybe not all of it, already.
Ed Hyman, his State of the Economy and 2023 Outlook are in Consuelo Mack Wealth Track.
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Starting with Wealth Track's launch in 2005, we established an annual tradition to sit down for a rare, in-depth interview with Ed Hyman, Wall Street's #1 ranked economist for an unrivaled 42 years. Hyman is vice chairman of Evercore, a leading independent investment banking and advisory firm, where he is also the founder and chairman of its Evercore ISI division and leads its economic research team, which publishes what are considered to be must-read research by institutional investors all over the world. A year ago, Hyman and his team were monitoring the U.S. economy still powering ahead, the multiple factors behind unprecedented nominal GDP growth, which included record low short-term interest rates globally, surging acceleration in money supply, the doubling of the Fed's balance sheet to nearly $9 trillion, and the more than doubling of the federal government's outlays to $7 trillion. All of this money flowing into the financial system and economy led to a surge in corporate profits and a very strong stock market. This was before inflation numbers ignited and the Federal Reserve started raising interest rates. Those two developments radically altered the financial landscape. As Hyman's recent reports attest, Fed tightening is already having an impact, and weakness is rippling through U.S. economy. I asked Hyman to tell us where he is seeing the most pronounced weakness.
Housing, and housing. It doesn't seem that bad because I travel around the country a lot with Zoom calls, but we survey home builders, and it's a disaster. Case-Shiller has a house price measure.
The index.
3 months rate of decline is minus 12%. Pretty much
Wow.
like it was in 07, 08. They had pending house sales, home builders, house price, and that was a free fall as well. So one of the things that's happening right now is people are saying, if the Fed keeps tightening, what's going to happen to housing? Because it's already getting shellacked. And our work
Right.
indicates that mortgage rates lead the economy by 1 year. So housing is clearly the weakest part. Next, we do a survey of trucking companies, and that has been in a waterfall. It's almost to a recession level. Housing is at a recession level. So I put our trucking survey as the next, and of course that reflects everything. So now I'm sort of glossing over your question to say it's getting weak pretty much everywhere.
Why is the trucking survey so important?
It has the highest correlation with GDP of any single sector.
Okay.
We do about 30 sectors, like home building, or trucking, or retail. And the overall has the highest correlation with GDP. But trucking is the one survey that by itself has the highest correlation. And it's understandable because you truck everything around. One of my other favorite indicators are the PMI, Purchasing Managers Indexes. And in November, they had about a 46 reading, well below 50. And that's it's well below the past decade. And then on the labor market, layoff announcements were 800 a week about 2 months ago. Now they're 9,000 a week. So the economy's starting to weaken. And it's because the Fed's been tightening
Right.
for a good while.
So there's a lag effect with Fed tightening that you've talked about many times. And the lag effect is usually kind of a year out, right?
Yes.
The Fed started actually really tightening earlier this year. So we're seeing a pretty dramatic impact, kind of sooner than a year out.
A good eye there, Consuelo, as usual. The, the most important measure of Fed tightening is through global short rates. It's not just the Fed. It's if ECB's tightening as well as the Fed and Bank of England and Bank of Japan. And so global short rates have been going up for almost 2 years, not 7 months. So that's plenty of time for it to begin to work through the system. And another metric, consumer net worth, which reflects the stock market and house prices, that's been going down, and that leads the economy by about 2 quarters. So it's all now starting to come in. So in 1923, when I was starting my career, John Maynard Keynes said that the money growth leads the economy by 16 months. And money growth's been slowing. It all fits together. And as you put it most succinctly, a year is enough time for it to start to impact, and it's starting to impact. There's another aspect, is that once the yield curve inverts, and it's really inverting now.
This is where that long-term rates fall below short-term rates. When you're talking about an inverted yield curve, what's the most important one as far as you're concerned?
So, in my view, in this case, because we're talking about the funds rate, I look at the short rate, which is Fed funds, minus the long rate versus the bond yield. So how do you know if the funds rate is high or low? Well, you look at the bond yield. And right now, the bond yield is 350 or 360, and Fed funds are 4.
Right, this is the 10-year.
That 10-year, headed to 5. And so it's already inverted. And just to keep the drama going, the San Francisco Fed has a proxy for Fed funds. Fed funds are 4%. And their proxy includes a calculation on quantitative tightening. The Fed is shrinking its balance sheet about $90 billion a month. And they calculate, if you take that...
Right, all those bond purchases that it was making.
Now reversing. And they calculate that has the proxy funds rate, or effective funds rate, at 6, and bond yields are 350. So you have a real inversion.
Right.
And everybody knows this. I'm not pointing out a single thing that's not as clear as we're looking at each other. And so when the Fed said, we see, we're going to slow down, the stock market had a mighty cheer.
There is a very healthy debate whether or not we're in a recession now. Do you think we're in a recession now?
Getting close, but not now.
Okay. We've had an unprecedented series of 4 interest rate increases of 75 basis points recently, kind of the fastest and steepest ever. So the weakness that you're now seeing, can it be laid at the feet of the Fed?
Yes, and they would like to have it there. They want to get the economy to slow down. They want to get inflation to slow down. My view is that they've done more than at least Powell talks about. If you take into account quantitative tightening, Fed funds aren't 4, they're 6. And mortgage rates were recently a little bit below, they were 7. The last time mortgage rates were 7 was in 2000, when Fed funds were 6. So it fits together. And then the bank deposits in the United States, as of now, are contracting. And as a result, the money supply, bank deposits are 85% of the money supply. The money supply is now contracting for the first time in 7 decades.
Wow.
But we should spend some time here on the most important aspect, is that it looks to me as though inflation is now really starting to slow.
Right, and that's another one of your headlines. One of your headlines to clients recently has been inflation is cooling. And where are you seeing inflation cooling? And you actually have talked about some deflation as well.
Yeah. So there are 6 measures we track that show rents are either slowing or declining. This is big stuff, and it's connected to housing being weakened, weakening. Now, it turns out that the government's measure of rents, it's called shelter, lags by about 8 months. And so this is all, it's going to come big time in 2023. Then another place, there is a Purchasing Managers Index for services, not manufactured. And they have a price component. And that's plunged for about 6 months, dropped 20 points. That's services, rents, and then say shipping rates, container shipping rates are down 70%. They've
Gee, so
plummeted.
this isn't just disinflation. I mean, this is deflation.
I don't want to overdo it, but I'm just
Yeah.
saying.
Okay.
And I think that what you're seeing now is the beginning of a process because of the lags involved. So I think inflation will slow. Let me mention one thing because you started it out. 1 year ago, on today's date, the futures market had Fed funds as of today, a year out, at about 50 basis points. And there's 4.
0.5%.
And so I'm just saying, the ability to know the future is very difficult. And so now we talk a lot about what Fed funds are going to be a year from now. And the going answer is 5%. And I'm just saying to me and you that, maybe it's 5, maybe it's 7, maybe it's 2. I mean, things change. My inclination is that the economy's slowing, inflation's coming down, and the Fed has done a good part of its work, if maybe not all of it, already.
So the evidence that you have just presented, Ed, is pretty overwhelming. It's actually pretty grim. And I'm thinking of, what the Fed has now is intending to do, which is moderate its rate increases. And they're talking about 50 basis points instead of 75. But from what you're telling me, do you think that the Fed should stop raising rates entirely or moderate the rate increases even more? I mean, how much are they overshooting the mark as far as their goal of, 2% inflation?
The element we haven't discussed is the labor market. I mentioned in some layoff announcements and claims.
Yep.
But that's where it's still pretty strong. And so I think the appropriate path for the Fed would be to do 25 in December and then wait and see. It turns out that the Fed has never raised rates once the yield curve has inverted. Once the bond yield has gone below the funds rate, it's paused. And so I wouldn't think they should pause right now. I mean, no further increases. But I would think 25. But at the moment, with the Powell saying that they're going to slow down the pace and the reaction of the market, I'm not too grumpy that they're getting the message and responding. And we got this morning another measure of inflation that was the Fed's favorite measure of inflation, called the core
Right.
consumer price consumption deflator, PCE, and it was only up 0.2, which is 2.5 or 3% rate of inflation. So the truth will win out. But the Fed has gone a long ways already, as we talked about, and they're probably in the process of winding that down.
One of the things that you've told me in a previous interview is that you try to be a little bit contrarian, or at least that you always want to consider factors that don't fit into your narrative, and the narrative right now is weakness and inflation cooling. So what are the things that aren't fitting into that narrative?
So the main thing is inflation. And Consuelo, you're such a good listener. You make me feel like I'm actually saying something understandable. But
You are,
but
Ed.
most people think I'm too aggressive on the view that inflation is cooling. Now that's changing recently because the data has been getting better. So I think we're in a process of inflation cooling, and I see lots of signs of deflation now. There's a Chinese internet company has launched in the U.S. and it's the number 3 internet company in China. They've launched here. They call it a price butcher. Mm-hmm. They're so aggressive, and they're selling a case for your phone for $2 versus Amazon is $17. So there's a lot of competition out there, car prices and rents I mentioned. But the one that has to slow down to make this a connected story is to get wages to slow. And that's the least convincing, is for wages to slow. And the data shows some of it, but not a lot of it yet.
Right. Well, with all the layoffs that you're tracking, I mean, it's at some point something's got to give there, and it's.
Let me mention that
Yeah.
the Philly Fed has a survey of people, and they ask them what are the odds of a recession, and they have the data going back into the 60s, and the current reading is the most ever by a very wide margin, more than it was, say, in 2008, more than it was in 99, more than it was in 1974. So people have the biggest impression that we're going to have a recession. This is a very strong statement. And again,
Right.
Where I come off on this is that it increases the odds that wages slow. Basically, 100% of CEOs expect a recession. So they're going to be.
What do you expect?
I expect zero growth, which probably has two down quarters. If you averaged
in 2023, zero growth.
Zero growth. And if
Okay.
I had to change it, I'd probably lower it some. And so right now, this is the great head scratcher. Everybody is saying, what do I do now? Because we're probably going into a recession, and earnings are going to be coming down, and yet the Fed may be starting to back off on tightening, and inflation is coming down. And at the moment, those two, inflation coming down and the Fed maybe slowing down, those have the market biased up. But people are scared to participate because they know earnings are probably going to go down. From a contrarian point of view, I guess I could maybe think we don't have a recession, which I have a hard time seeing, but not impossible. So the other possibility is that we have a really severe recession, because the consensus is overwhelmingly we have a recession, but it's mild.
Soft landing.
Soft landing.
Right.
I think what the Fed has been doing is pushing that narrative further and further away from us. You know, if they tighten to 5%, which would put this Fed funds rate adjusted for quantitative tightening, taking into account both of them, put that at 7, and bond yields
Right.
are 350, we're going to have a recession.
So what does this mean for the stock market? Because if earnings get hit, if earnings are going to be lower, then the stock market's going to be lower.
There's a way people talk about it. I have a high conviction call. They'll make that. I have a high conviction call that inflation is slowing. I have a
Right.
pretty high conviction call that the economy is slowing. On the stock market, I don't have a high conviction call. But we have in our shop a technical analyst who's been fabulous, Rich Ross, and he is just flat bullish. And he thinks the market's, been oversold, it's now bottomed, it's going up. And so right now, I'm just sort of going along for the ride. But I have
Yep.
plenty of cash in case that's wrong. But it's getting a little bit more encouraging to me because of the inflation cooling and the Fed responding to that. And I think inflation is going to keep cooling. And I guess if the Fed then keeps responding, you might have the market continue to do a little bit better. But I'm very concerned about the things I talked about earlier. Quantitative tightening, the yield curve being inverted, the money supply contracting. So there's, I won't say that I sleep really well. I wake up occasionally worried about this stuff.
There has never been a Fed tightening cycle where you don't have a financial shock, at least, or a financial crisis. What do you think?
Never have you had a tightening cycle that didn't have a shock or a crisis, without any exception. And so I'm waiting for one. And of course, FTX, the crypto blow up in the Bahamas. I thought, well, maybe
Right.
this is it. But so far, it doesn't look like it's a big one. So one of the feelings I've had is that the odds of having a shock or a crisis are 100%. And it has seemed to me that the Fed puts the odds at 0. Because they keep, saying, the terminal rate will be 5%, next year. I'm going like, between here and there, something is going to float to the surface.
It's going to give.
Something's going to give.
You mentioned that you are holding cash. What are you doing personally? How defensive are you being in your personal portfolio?
Let me first say, as well, not defensive enough. But I have, by what would be most standards, a lot of cash. And I can tell whenever I have an opportunity to put it to work. Right now, I'm like, no. Because I also have, a lot of exposure to risk assets, both equities and real estate. Speaking with you here today, I feel pretty comfortable with my position, but I don't feel like adding to my risk, and I don't feel like, frankly, adding to my cash. So I feel pretty, safe okay with what I'm doing at the moment.
One investment for a long-term diversified portfolio, and when you were on a year ago, very different circumstances. You had a portfolio for us with technology, Apple and Amazon, and housing, Lennar, and also healthcare, Pfizer. All of those stocks are lower, especially the tech stocks. What's your view of that portfolio today, again, for long-term investors? I mean, would you bail out? Would you add to? Would you just leave it?
Well, to be honest with you, I would just leave it. That's what I owned then, and I still own that. This year, I might add some energy to it because that looks better. So I like Schlumberger. I still like the healthcare space and the tech space. But I might tweak it a little bit. But I still, I'm a long-term investor. Actually, come to think of it, I am a long-term investor. And to be honest with you, it served me very well with some major dips like this past year.
Ed Hyman, thanks so much for continuing our annual tradition of sharing your outlook for the new year on Wealth Track.
Thanks for having me.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is prepare yourself for more challenging economic and market conditions. As Hyman reminded us, the impact of monetary tightening occurs with 1 or 2 year lags, so the rapid and dramatic tightening we've experienced since early 2022 won't be fully felt until 2023 or beyond. Tightening is already hitting home buyers and developers who are feeling the impact of much higher mortgage rates. Investors are feeling the heat across the board. Bond prices, which fall when interest rates rise, have had a brutal couple of quarters. And with the exception of energy, all stock sectors have declined in 2022, with more pressure to come as earnings expectations are lowered. Now, Hyman mentioned there has never been a tightening cycle without some sort of a financial shock or crisis, so be prepared for that eventuality as well. The Stoic proverb, prepare for the worst and hope for the best, might be an appropriate mindset for 2023. Well, next week, leading strategist Jason Trennert warns of more economic and market pain ahead. In this week's extra feature, inveterate reader Ed Hyman gives us some book recommendations for holiday gifts. Please follow us on Facebook, Twitter, and our YouTube channel. Thank you for spending some of your precious time with us as we enter the busy holiday season. Have a super weekend and make the week ahead a healthy, profitable, and productive one.